It was listed at 995. The other one was full price. The deal was like we would buy all the existing furniture for like another 4K. But I think they liked us because we came up there the next day and they meant us and we sat there and talked to them. We brought our secret weapon, which is my daughter. They were like grandparents and they gave her like a little teddy bear. Obviously, that's $1 million teddy bear because we still have it. It might have been a jump ball, to be fair. We came up there and we made a real offer and they kind of saw us and were like, okay, these are real people. We won the deal. So there's also nothing like showing up. All right, welcome back to STR Like the Best. I'm your host, Michael Chang. I'm super excited for my special guest today, Eli Cohen. Eli and I got to know each other when we were both in business school like 17 years ago. We both interned at Citi as investment bankers. Eli was much smarter than me and set on a different path. And we're going to talk a lot about that today, about his real estate investing journey and what he's done in the last 10 years and what he's working on now. If you're your first time listening here on STR Like the Best, I'm your host, Michael Chang. We generally focus on short-term rental investing, but today we're going to talk more about just broadly real estate investing. Eli comes from a different part of the real estate investing world and has some really cool insights that I want to share with you guys today. So without much further ado, hey, Eli, great to have you on.
It's great to see you and great to be here. Thanks for having me.
No, thanks for joining, man. Like, it's rare, we don't talk super often. I was very happy to see that you were posting on LinkedIn about what you're working on. And it's great to kind of use this as a platform to reconnect. We talked a bunch before the recording today, and now you're working on some really, really cool stuff. I really want to share with the audience. Today, we're going to focus on two main topics today. One is Eli is like one of the best multifamily investors that I know, and he's done extremely well. He's been in this business for a very long time, and I want him to talk about that part of the business, about multifamily investing and his take on that. And it's pretty controversial, actually. So you definitely want to stay tuned and see what he says. And then we're going to talk about fast food and real estate and how he's combined the two concepts into really maximizing his real estate portfolio. So if you're listening here today and you find this interesting, please subscribe, share with a real estate investor friend that you think this episode would add value to them. So, Eli, please introduce yourself to the audience.
Well, yeah, thanks, Mike. Eli Cohen. I have two businesses today. One, C5 Restaurants. We are a franchisee of two brands, Fazoli's, which we own 6 stores in West Texas, and an upstart brand called Lane's Chicken Fingers, where we are developing 40 stores across West Texas and through San Antonio and Corpus Christi. And then I also have Cohen Rojas, which is my multifamily investing business that I started a year after our summer together in New York. Both of us finished business school at a pretty terrible time, 2009, but that's, I kind of look back on it and it's one of the luckiest breaks that could ever happen to me. Got forced into entrepreneurship a lot earlier than I otherwise would have. I think if I graduated at a different time, I would have gone and worked for someone else, and who knows where I'd be right now. We actually started investing in single family homes in Sacramento, renting them out, scaled up, started buying multifamily deals in that market, moved to the Bay Area, San Francisco Bay Area, where both of us are from, in 2011. And our core competency, if you will, was buying walkable urban rent-controlled buildings and really understanding how to navigate rent control. 2017, we really made a change in the business, looked at the cost of living in the Bay Area, looked at the competition to acquire real estate here and the political headwinds, and moved the business out to Boise, Idaho, did a mix of ground up development there, value add garden style deals, and expanded across the mountain states into Montana and Colorado. I guess about 5 years ago, we slowed that business down dramatically. I know we're going to talk about that down the road. Still have it. We're doing very selective deals, and we've got about half of our portfolio that we acquired. We've acquired about 600 million over the 15 plus years since we started the business, and we still have about half that portfolio under management today. It's all very stable. That's a quick background, Mike.
Well, it's actually the first time I've heard you kind of talk about this in just kind of coherent form. I remember getting your investor emails. Those stopped. I actually always read them, and I really liked them, actually.
Well, thank you. I think we got lazy. I think we always gave the company, and we were hungry. We wanted to get everybody in our circle, and then we had enough like individual deals under management that it was like we were sending the quarterly updates on individual deals, and if anybody wanted to know about the market, they could kind of reach out to us. But those were fun to put together. It was a good exercise. Yeah, it was.
It was quarterly. It was quarterly for a long time, and then the quarterly became like an annual or like semi-annual or annual, and then it stopped. So I was like, he's either doing like super well or like it's not doing well at all. So like if it's doing super well, eventually I'll hear from him. If it's not doing well, then obviously I don't want to like I don't want to offend anyone.
Yeah,
And then, but then and then I'm like, no, I'm sure he's doing I'm sure he's doing just fine.
it was a nice
Um,
run. It was a
it was
nice
a
run.
nice
Know
run. No,
anybody who
like
made levered bets on multifamily real estate from like
'09.
2009 to 2020? Like, if you didn't do well, you really did something wrong.
We met through our mutual friend Chaya. Chaya and I went to undergrad together. He was my big brother in our fraternity. And then how did you and Chaya meet?
Chaya dated my friend Danielle from Lowell, my high
Oh
school.
yeah. No, I remember. Yeah, that's right.
Yeah,
Danielle was his girlfriend. I forgot about that actually. Oh yeah,
yeah.
that's right. And then we got connected, and then we did banking together at Citi, and then talked about how much we hated it. I stayed, sadly. You were smart and go out and make levered bets on multifamily after the biggest real estate crash. So kudos to you. You definitely made the right call. Maybe just like, instead of kind of going through like every single point there, right? Like, do we just synthesize like where in the market are we now? Like you've had a, 16-year, 17-year run. You bought 600, you've sold 300, you still hold it. You said you've done a few deals. Like give us a state of the market.
Yeah. Well, I guess I would say the state of the market, I'll bifurcate that. There's an institutional state of the market where people are going out and buying, multifamily is a stay rich asset class. And I would say if you kind of look at where returns are in multifamily today versus when we started the business, I think it all starts at the institutional level. And,
Well,
back
can you
when we,
define that for us? Sorry, can you sorry,
yeah,
I didn't
yeah.
interrupt you.
So
Define like because I think like what is that? What is institutional
institutional
subs?
level, let's say over a
Yeah.
$100 million asset acquisitions. And I think a big part of the reason things changed is when I started this business, the favorite asset class of institutions was office buildings. They could place a ton of money, they could have credit tenants that, it was very consistent cash flow. COVID hits, that changes, and multifamily and industrial become the darlings of the real estate industry. So as demand increases, returns compress. So that's like kind of overall
Mm.
multifamily. In our space, what we've done is value add multifamily, meaning a property is in some level of disrepair, be it physical or operational, and we come in and clean that up. No one is building value add multifamily right now. You can't build it. It comes out from poor operations. I mean, so the supply of value add deals, like a group like us buys one, and it's not 100% chance that it doesn't return to that pool, but for the most part, like the value's been added, it's out
Hmm.
of that pool. So we've seen demand in our asset class go up. The supply of assets that would meet our threshold has gone down. So what does that do to returns? It lowers them. It's just, econ 101, right?
So let me ask you a question there, right? So because like I remember post COVID there was like this huge rush of buy multifamily homes. I remember like I saw this guy on YouTube. He was like a lender in Texas. It was James Ing. And then I called him. I was like, hey, yeah, like I'd love to get into value add, multifamily in Texas and buy like a, 30 unit in the middle of nowhere. And he looked at me, he was like, do you know how many calls like this I get every single day? Because of course he wouldn't take my call. And I had to
Yeah.
like I emailed him probably like 10 times to get on the phone. And then he finally gave me like 15 minutes. He was just like, do you know how many calls I get from New Yorkers that like are doing the exact same thing?
Yeah.
Like, are you from here? Like, what edge do you have? I was like, I just found this is interesting. He's like, dude, you're gonna get absolutely annihilated down here. So like, don't even bother. And like, don't waste my time. It's like
Yeah.
actually really good advice. Or I
It
mean, living in
was.
like a middle of nowhere in Texas because all of that there was like so much speculation in there and. Actually, just candidly, just through my network, like I've just heard a lot of people lose a lot of money in a lot of those syndications. They just either capital call or they're just completely wipeouts. Do you think that's kind of a symptom? Like that it was just like post COVID, office became less investable. There's all these people that came into multifamily, prices traded up. People weren't there are a lot of people that weren't experienced and a lot of people got hurt. Is that like a
Yeah,
fair
I think you
assessment?
just kind of watch the market go up and up. So people who did invest before made money, then everyone thought they were very smart because they didn't make money because they did so great. They made money in spite of themselves. And so once you make money, then you go out and you raise more. And it was a weird time in the market where everybody was just
Uh,
like location agnostic. Everything was a four cap. It didn't matter if you were in middle of
yeah.
nowhere, Texas or New York City. And that doesn't make any sense.
The good old days.
Yeah, I mean, I think it was a weird time for a lot of asset classes. I think there were a lot of venture deals that got funded then because money was
Yeah.
free that wouldn't today. So I don't think it's necessarily unique, but yes, there's a lot of, I'll call them bad actors in my business of syndication and even non-bad actors. I think it's, part of the reason I've slowed down that I think we'll get into is like I even look at myself and I've invested with other GPs, and my returns as an LP investor are terrible. Like I would be
Yeah.
way better off if I had just bought a REIT or bought the S&P 500.
Yeah. Well,
And I'm supposed to be an expert at this.
yeah, no, I mean, like, I think, well, anything in S&P in the last 5 years, you're doing quite well, or the Qs, you're doing quite well. But look, I
Sure,
mean, I think that's a really good point, right? Like, I think you highlighting 2 points here. One, you're an expert in this. I mean, you've been doing it 16 years. You're probably the only multifamily guy I would ever give money to do this, just because, like,
thank
obviously,
you.
like, pretty sensitive to the inherent conflicts or the issues with syndications. I think I tried to invest in you before. I think it's just not enough money actually back then. But we'll get hopefully you're
One of these
gonna
days
be
we'll
an opportunity
find
in
the
the
right
future.
one.
There you
Yeah,
go. But what I wanted to say was more like even you as an expert, like as an LP, like didn't do as well, right? And so I think it just comes to a lot of like you got to place the right bets. Is also timing. It's not always about chasing the hottest thing out there, right? It's about
yeah.
like really understanding that asset class. And even if you do, it, you still make mistakes. So like I kind of teased out in the beginning of the show right now, like for the regular retail investor, like where is
Mhm.
multifamily investable? Like I want to invest in multifamily. Like what do I do? Eli, what do I do? It's the only thing I want to invest in. What do I do?
I mean, today the public REITs are way cheaper than the private markets.
What
But
does that
that's
mean?
kind
What
of
does that mean? What does that
means
mean?
the publics are trading it as, let's call it a six cap, and if you went out and bought an apartment deal, you would pay a five for the same assets, so they're 20% cheaper. You get a diversified pool of apartments, you have efficiencies of scale and management, and you don't pay a promote, and their cost of
You get
capital for
liquidity.
debt is, yeah, and fully liquid.
Why would anyone buy like a five that's illiquid and private and all that fun stuff versus, going on my Robinhood account and just buying Avalon Bay?
Yeah, it's interesting. When COVID hit, I spent in that year, again, everything was trading at like a 3.5 or a four cap. We didn't do a single deal in 2020. I kind of looked at the world and was like, yeah, there should eventually be a vaccine, but we don't know that. We don't know when. So why would I
Mm,
pay a 3.5 cap for multifamily? And then in the public markets, you could go buy any of these REITs for a seven cap at the time. And I tried telling our LPs about it, and I said, "Listen, this is where you should be investing right now because everybody was flush with cash during COVID. Money was free. They wanted a place to put it to put yield, and we were just like, we are not buying right now. There is way too much uncertainty out there, and you're not getting paid for that
yeah.
uncertainty. This is the place to do it in the public markets, like really high quality portfolio. I couldn't get anybody to do it. Thought was like, oh, maybe if you raise a fund and you do that, I would invest. And it's like, well, then you are paying fees, you are paying a promote, and it kind of takes some of the reasons to do it.
Why put in a fund if you could just do it yourself? Buy Avalon Bay stock.
Right, that was my take on it, and why we never did that.
Yeah.
It's interesting to me. I feel like you have a lot of people that will invest in index funds in the public markets, don't try to pick single stocks, yet in real estate for some reason they think that they can do that, and they invest
Interesting.
with individual GPs and probably more than they would put in a single stock if they were to do it. And a lot of these things are levered with floating rate debt. And, every once in a while, you can absolutely find a deal. In the past 4 years, we've done two deals, none in 22, none in 23, two last year, and none this year. We're picking our spots. Like there are times where we do believe that we can outperform, but it's kind of like if these diversified options are out there and I'm offering you an illiquid concentrated investment, how much do I need to outperform by to justify
Yeah.
that? So it's got to
Agreed.
be a really good deal.
I'm just curious, just like before we leave that point, like what about those two deals in 24? So you didn't buy anything in 23 for your fund, 20, 21, 20, you didn't buy anything. 21, buy anything? No.
Unfortunately, we did a couple deals in 21.
Okay.
Anything you bought in 21 doesn't feel great today. That's just the vintage. I will say, kind of since you and I finished school,
Mm.
the Fed had been guiding, we've got your back. And then, early 2022, Putin invades and the Fed explicitly says, we no longer have your back. And we listened and we just shut it down. And we're just like, we're gonna see what happens here. There's a lot of groups that kept buying and we didn't. We did do a couple deals in 21, which obviously I wish I had a mulligan on, but we have fixed rates out. We'll ride through it. They'll be fine.
By the way, credit to you. I think a lot of people wouldn't even said that. And I think that's like to your credit about like how long you've been in this business, like how transparent and I think personally your integrity, like just like, yeah, like those are deals that we probably wouldn't have done. And, we had a do-over card, you probably wouldn't have done, right? We're smart enough at least to have the fixed rate debt and like, I'm sure other design, other features of the deal that allowed you to ride your volatility to your credit. I've seen a lot of deals where it's like, 3-year float and then
Yeah, but no doubt if we had to sell today, they would be losses. We haven't sold, but yeah, nobody bats 1,000. There's just you can't be in this business for 16 years and bat 1,000. That's not a
that's not
thing.
that's not a real track record. So what about those two deals in 24
Yeah.
what about that did you like? And then let's move on to the next topic. What about those did you like?
Well, one of them was in our hometown in San Francisco. It was our first deal in California since 2017. San Francisco was a no-fly zone for institutions. There's no way. You have two of the best universities in the world. This is the epicenter of AI. This thing will come back. We bought that deal. It was 165 units. We paid 225 a door off of EQR, which is like one of the largest publicly traded REITs. It was over a 6 cap going in, and it was just like this is. I just wish we had bought 10 of them because it was just such a no brainer going in. Where it was like average rents in the building were 1,900 a month. Pre-COVID, they were 2,600.
Wow.
Yet incomes in San Francisco were up in that time. There's been no
No
supply.
supply. Yeah.
So I think we bottom ticked
Nice.
San Francisco on that one deal. However, kind of been talking about how no one bats 1,000. The other deal we did in 24 was going back to Denver. This deal we bought is 217 units in a Cap Hill area of Denver. The seller's basis was 52 million. We paid 37. So good area that we own in, kind of buying the dip on Denver, a market that we knew or know really well. And it's been a tough year in Denver. So I still think the deal will be fine, but like we definitely didn't bottom ticket. We assumed a really good 5-year debt on it at like 3.6%. We paid 170 a door in an area where there's a ton of development. That's just so far below replacement
Yeah.
cost. I think we'll hold on. I think we'll be fine. But it's been a choppy year,
Got it.
to say the
Got it.
least.
No, that transparency just earns you a lot of respect and a lot of. I've been involved in a few, syndications that didn't work out well, and the ones that actually kind of tell you, like, hey, these are the problems, this is what we're doing. Like, I get it, and it's fine. No one bets it. The ones that are really annoying, the ones they don't tell you anything, and then they stop distributions, or you get an email for a capital call, and you're like, wait, what?
Uh,
What happened?
I've found that the worse, yeah, the worse these deals perform, the worse the communication
Yeah.
is, and we try to take the opposite approach to that. That when things are bad, you really need to
You
communicate.
really need to communicate. We do a lot of short-term rental work around Denver because you can't do short-term rentals in Denver because of the regulations, but around
Yeah,
there, towards Breckenridge, like there's some really good markets that we really like. We're familiar and that we have a number of our clients that work out there. So yeah, like
yeah,
we're also long-term bullish on Denver. But let's talk about
good.
chicken fingers. Nothing like a good chicken finger, right? And chicken obviously
Yeah,
really big right now with fast food / QSR, quick service restaurants. Beef is too expensive. There's like an antitrust investigation right now for beef meat packers.
yep,
But chicken's been huge, right? With Raising Cane's, with a bunch of the other concepts out there. And we're not a franchise kind of show or anything. So maybe if you could just give like a 2-minute primer on that style of investing, combining real estate and fast food, that would be really helpful to kind of set the
yeah.
stage.
I think one of the things that we can't do on the multifamily side is you can only create so much value. And as I tried to think about, well, what could I do on the real estate side that would outperform? I think in commercial real estate, if you put the right tenant in, you buy up an office building and you buy it vacant, and you lease it to Google, like you've created immense value. You can't do that by like changing the countertops and pushing rents by $50. On the commercial side, you can create so much value. And so if we just focus on the real estate side of what I'm doing in franchising, I am the tenant. So I can go in and either buy land or buy a second generation restaurant. What I mean by that is like a KFC or a Jack in the Box that closed down, buy it for cheap, renovate it, put my own brands in there. And I've added value because I am the tenant and I've put myself in.
Mhm.
Some of these deals I could go out, I can actually make money on the real estate and expand my business, get a new store, which as long as the store operates, like there's value there too. And then on other sites, it'll be, I'll acquire the real estate. I won't make money on the real estate. It'll be a slight loss, but I'll get my business, I'll find a location that I want for my business. And we are developing 40, this brand's called Lane's Chicken Fingers across West Texas through San Antonio and Corpus Christi. And as a guy who loves doing real estate deals, if I'm building 40 stores, I get to do 40 real estate deals. Maybe you double that if kind of look at the acquisition and the sale of said site.
Can you give an example of like what's a typical deal look like, right? Why don't we do one where it's like you buy
Yep.
like a shuttered, KFC for example, right? And then like what
Yep.
does that look like? And then, high level, you put in a lanes in there. Just give us some high level financials if you don't mind.
The best one that I'm doing, I paid $900,000 for a site right by Texas Tech's campus in Lubbock. Building was built in the early 2000s, so
Okay.
it's not that old. We will put in our own kitchen, put in our branding around the dining room, the FF&E, all of that. I think that'll cost probably 800
Okay.
grand. So we'll be in that site for 1.7. I think it's easily worth 2.5, depending on where we set the rent. So in that scenario, I've acquired a site. I will actually make money on the real estate. And I have a new restaurant right by Texas Tech's campus that I think is going to perform really well. College kids love fried
Love fried
chicken.
chicken.
Yeah, yeah. We got the Lubbock High School is a block away too, which is a couple thousand students.
And then
So great location. That's my best
okay.
buy.
So then, you're okay. So I just want to break this down. So 900 for the land, 800 to refit it out. You're in for 1.7, 2.5 an ARV concept, right? So it's going to work 2.5 based on the rent that your business that you own is paying there. So you have a lot of flexibility there, right? You can charge yourself $1 a year. You can charge
Yep.
yourself $1 million a year, right? And that's obviously gonna have a big impact on the value of that real estate. So I guess like for investors, like how do they think about that? And is this something where it's like, are you selling it to yourself and leasing it back? Like, just kind of curious on that structure.
Yeah. Well, I guess the first thing I would say is these brands trade generally. A portfolio of fast food restaurants going to trade at a lot lower multiple than a single tenant
Mm,
net lease piece of real estate. So if you say that the business is worth a 6x, even if the property, and it's not going to, but let's just keep it simple and say it sells for a 10 cap, which is a 10x, you're way better off charging yourself more rent. If you charge yourself 200,000 in rent versus charging yourself 100,000, right? It takes away 600,000 from the business,
so
right?
it
But you've created $1 million in value and you have that $400,000 spread. So as much as you can justify charging yourself in rent, it's a no-brainer to do
So
it.
just to pause for a moment. So for folks, if you're listening, right? So what Eli is saying is if the real estate trades for 10 times, like a 10 cap, right? So $100,000 of rent, that property's worth $1 million, right? So 100,000 times 10, right? But the business cash flows is traded at like 6, right? So $100,000 of profit in that business is only worth 600,000. Then it obviously makes sense to push as much cash flow as reasonably possible into the real estate side because you're getting someone's paying you 10 times for every dollar of earnings that you're getting there versus paying you 6 times for $1 of earnings within their fast food restaurant.
That's correct. And in reality, that multiple is higher than 10 times on the real estate. So the spread's even bigger. I just
Yeah.
wanted a round number. So we use the 10
Got
times.
it. Got it.
So,
Okay.
I think it's a dance because it has to be a rent that your business can actually support.
Mm.
For the next buyer has to see, okay, this is the business will support this rent. You can't just go charge yourself 500,000 in rent and think that you're going to sell it for $8 million. That's not good. There's the ceiling
Yeah.
there, but as much as you can justify, you're better off putting it in rent. than saving money for the
So
business.
why you have one. Why not just get a couple? Why 40?
I wanted to do as many as I could in the state of
Okay.
Texas. This brand, I mean, you mentioned Raising Cane's. Lanes is basically the same model as
Hmm.
Cane's. Really simple. You can order two chicken fingers, three chicken fingers, four chicken fingers. It actually started 2 years before Cane's, which so it is not a ripoff of Cane's. It started before Cane's. We have spicy tenders that Cane's does not have. We have, I think, five or six different sauces. And then we have really great milkshakes. There's nothing sweet at Cane's. So there's a few things that we have, but it's an incredibly simple business. It's taking off. It's going to take off everywhere, but particularly in Texas. It was founded by a couple of A&M
Okay.
students in 1994 in College Station,
Wow.
Texas.
Okay.
So that's where it's founded. And it's been like this College Station institution, and they just started
Got
franchising
it.
a couple
How
years
many?
ago.
So
And there's a few hundred restaurants sold. And they have, I think they're about to hit 50
oh
open.
wow. Okay. Okay. How many do you have open?
I don't have
Oh,
any
oh, you
open yet.
didn't. Okay.
Our first will open in
March.
March.
Okay.
We
Oh, okay.
have, yeah, we have four real estate acquisitions like that are the one that I just gave you an overview of is the best one. We have another one where we paid 2.5 just for the
Mhm.
site in San Antonio. It's a hard corner across from an HEB, which is the Texas grocery chain. It was a site that we really wanted to locate our business at. Fine, losing a little money on the real estate to get the location that we
Nice.
want for the business.
That's great. I mean, like you own the business, you own the operating business in the real estate. Just a lot more flexibility on like where you can place it, so you're not like a tenant. Obviously, like if you're a tenant with someone else's building, you kind of have to like listen to them, and they kind of tell you where you are. You have a lot more flexibility there. You can build out
There's a mix of
from there.
both, though.
Go ahead.
Yeah, there's a mix of both. I mean, I'll sell these, so I won't be the landlord.
Okay.
I would rather take the capital out of the real estate and reinvest it back into the business. If I have 40 Lane's chicken fingers in Texas, I don't also want to own 40 pieces of real estate. Even if I thought that they would perform well, there's something to diversification and liquidity. Like I'd rather have it in the S&P 500
Okay.
over time. And then we're gonna lease some sites also.
So basically, you're gonna develop it and then sell the real estate to another investor, and then have a lease for X number of years, and then you own the underlying chicken restaurant business.
Correct. Exactly.
Okay.
Exactly. And they keep the real estate.
Oh, okay. Okay. Very cool.
Yeah. So that's
So
how I get the capital out. Like that deal that we just talked about, the two and like I made it for 1.7. That capital doesn't stay in the business. I go sell it for 2.5. I got that capital out, and I can go build another store.
how long do you think it'll take you to get to
Yeah. Just
40?
keep doing it, selling.
How long do you think it'll take you to get you to
We
40?
did 10 years in the agreement, but my hope would be that we're well on our way in 3 or 4 years, and we're buying new territory with the brand.
Nice.
And there's nothing. Texas is sold out, but maybe we'll go to Oklahoma or Kansas or who knows, somewhere around there.
Come to Tennessee. That's where I have all my short-term rentals.
Come to Tennessee. Yeah,
Come to
yeah.
Sevierville. Come to Knoxville. Come to Sevierville.
I bet it would do very well. Fazoli's, our other brand, does really well in that by the Smoky
I
Mountains.
I I
Some of the best
really
Fazoli's.
really like East Tennessee. I'm like obviously like we invest there, like that Knoxville, East Tennessee side. I think it's just like real estate's so relatively inexpensive. It's pretty accessible. There's direct flights now from New York City, for example,
Oh
into
wow.
Knoxville. Yeah, it's Newark, so it's not like easy as like JFK or LaGuardia, but I mean it's hour and 30 minutes to Knoxville direct, and I can get to my properties, and the Smokies is like an hour drive. So it's like I think it's like a 9:40 flight. I'm there by 11. I get my rental car, just Starbucks right there, and I'm there by 12:30. So it's a
Oh, that's
really
great.
really efficient. And like Knoxville has the University of Tennessee. It's like right in the city. It's
Yep.
just it's just like this kind of like small, well, mid-sized town. It's like a good
Have
vibe.
you been to a game yet?
I want to. It's super random. I don't know why. I mean, this is why I had Infinity Tennessee. They were good when I was growing up. We didn't have cable when I was growing up, but they were a good SEC team. So they were always on CBS, and I was only the one I had access to. So I always watched
Hmm.
them on CBS. So I was on affinity towards the University of Tennessee. Now I have to go check out a game, but
There you
I
go.
really like that area. I really like that area. I think it's a great place to invest. But like I actually want to just circle back. Like you've obviously done well, right? Or I presume you've done well because you started in a great time in the market. You have a family. You live in a beautiful part of the country. I don't know how good your tennis and golf game are, but most people kind of default to that after they had a good first act. Why drive around San Antonio right now in West Texas? It's pretty hot versus working on your handicap.
Well, my golf game is mediocre would be a generous term to describe my golf game. I do like it. It's fun. It's actually been probably more fun to be unable to play golf more than maybe once a month these days. I'm much happier like that. I am not wired to just sit on my hands, and there's nothing better than learning, and I'm learning a ton in this business, and dealing with and working with just much different people. We're building something, and I'm really excited about it.
Was there like a spark? I mean, like obviously, like you understood real estate. You have the capital. You have the time now. As you said about multifamily investing right now, just not a great time. I'm sure it'll change. These things are all cyclical. At some point, it'll make more sense to lean back into that. But was there something
Yeah.
like in your research or network, like what led you to lanes?
Yeah. Well, I started looking for other asset classes of real estate to invest in, just thinking, okay, I can't outperform in multi. Can I do it in commercial? Because as we talked about earlier, like I think you can outperform in commercial. I don't think I'm the guy to do it. I don't think I have the skills and the network to go and buy commercial real estate, put the right tenants in, and outperform there. Thought about it. Don't think that's me. I got the idea to go out and look and potentially buy an operating business, and I started looking in construction because that's more of my background. We've done development, we've done very heavy renovations. That was my background. I started looking on biz buy sell, looking for a business to buy, and I came upon this portfolio of Dunkin' Donuts stores that were on military
Hmm.
bases. And I just thought, look, this is an incredible moat. Like, there's no
Yeah,
competition on these bases. I want to understand this business. This guy was in the Air Force. He loved Duncan and basically was like, when I get out of the Air Force, I'm going to put a Duncan on every base. And he went out and he did it. And he was based in Colorado Springs. And we have, as we talked about, a lot of apartments in
yeah.
Denver. So I'm out that way all the time. And I went and spent time with him, spent a day in the Springs, learned about his business, and I really wanted to buy it. He ended up selling it to an existing franchisee instead of me. He was worried about me getting approved by Duncan, but it just opened this can of worms, and I was so interested in fast food, or QSRs as we call them, and I started doing the same thing that you would do if you were underwriting a new market on the real estate side. So I looked at any package of QSRs that was available on the market. I signed the NDA. I underwrote them all. I wanted to see how they operated. Then I wanted to understand what they traded for so I could value them. And I did that for months. I talked to anybody that I could. I listened to any podcasts that I could. I just kept learning and learning and learning. And this portfolio of Fazoli's in West Texas came on the market. I had never heard of Fazoli's, and I had never been to West Texas. I signed the NDA just to underwrite it like I did every other deal. And what was different about this one was this was the top franchisee in the Fazoli system, over 200 stores. So yeah, he'd been with the business for over 25 years, two director of ops that had been with the business for 20 years, which is a huge team for just
Yeah,
six
that's huge.
restaurants. But an experienced and extremely successful team. Four of the six general managers in the restaurants had been there for over 15 years. So they really run these well. The retention was great. And so it was just this really high quality team. Pricing was great. I paid a 3.5 times multiple, including all G&A. And, kind of as mentioned, it was like, well, this G&A is built to
Yeah.
scale. So I want to take this incredible team and scale it. And I want to find another brand to do it with. And met with a lot of different brands and was super impressed
Nice.
with Lanes.
No, it's awesome. No, it's cool. I wish I wish I started with that because that's a really cool story, and I think that's just like for anyone listening right now. You're probably really just interested in real estate, probably more so just interested in a business that you can develop for yourself. For me, I did it in short-term rentals. Obviously, took a different tack than Eli, but it's the same kind of thing. You find something that you're interested in. You're just maniacal about understanding and figuring it out, and every single angle that you have there, whether you listen to podcasts, you're underwriting deals, you're flying out to Colorado Springs and networking with people. It's just the same process, and just you have to like love it and want to do it. And as we kind of tell my clients, like as they're looking for short-term rentals to buy, like you just keep looking, and the more you look, the more that when the right one comes, you'll know because you've seen so much already. You're like, this is the one, right? Whether it's the people, it's a team, like whatever it
Yep.
is, there's just like this is different, and you just have to have enough reps to take a look at and see that this is different. And if you don't do the reps, you're just not going to know. You look at one or two deals, like whatever, right? But you look at 20 deals, you're like, okay, that one that pops up, you're like, oh, this is the one, and you want to move quickly, and you also have the conviction to move quickly because you really can understand that, and you have you have conviction in yourself that you've done the work. So it's really cool. I love that you shared that story. I think it's it really speaks
Of
to
course.
entrepreneurship and like successful entrepreneurship, right? It's not something that
Yeah. I mean, what percentage of deals do you do that come across your
we
desk?
probably looked at like, I mean, just for myself, the last deal that we bought, we probably looked at like 40, 50. I mean, we have a Google sheet, and every tab is like
Yeah.
40, 50 deals. But that one that we saw, it was crappy iPhone photos from the agent because the seller was really cheap. Great guy, but just like very cheap, and would only paid like a very, very small commission to the selling agent. So they didn't go and do any marketing. She literally took some pictures on her phone. But we had looked at enough where we knew, once we said, we're like, hey, wait a minute, this is different. And then we saw the pictures. They were like crappy iPhone photos. So we were like, oh, wait, like this is actually good. And we looked. And then we went up there the next day. We saw it and we made an offer that day. And this is over a weekend. They had another offer and we bought it. And,
Yeah.
a year and a half later, it's done really well from a cash flow perspective, 20+%. And their real estate's appreciated probably like 25% since then, just because the market continues to move with bonus depreciation. So
Yeah. And you had the conviction from saying no so many times to bid to win. That was the time to step up, beat out the other offer. You don't, but if you hadn't, you wouldn't do that
it
unless you had
it
rejected
was
that many
listed
deals.
995. The other one was full price. We ended up the deal was like we would buy all the existing furniture for like another 4K. The other party wouldn't do it, or maybe they did, but I think they liked us because we came up there the next day and they meant us, and we sat there and talked to them.
Yeah.
We brought our secret weapon up there, which is my daughter in her stroller, and brought it up, and and then they were like grandparents, and they gave her like a little teddy bear. Obviously that's $1 million teddy bear because we still have it.
That's
And
right.
yeah, I think there was like it might have been a jump ball, to be fair. I think that we came up there, and we made a real offer, and they kind of saw us and were like, okay, these are real people. We won the deal. So there's also
Yep.
nothing like showing up and just like meeting someone and
Yeah.
being like, hey, it's an offer letter, but we're also real people, and we want to buy this because we want to buy this, and we will stand behind what we say. And I think that in the end carried a lot of weight.
Absolutely
All right,
did.
man. I don't want
That's great.
I don't want you to get in trouble with your wife any longer, so I'll let you get back in there. Hey, Eli,
You'll let me come back in the
it was
house.
really great to catch up with you. Eli and I have known Jennifer again for a very, very long time. I think the last time we saw each other was like Chaya's wedding, maybe.
No, what was you were in Mill Valley? You're starting this
I think we're
business.
on the phone. Oh yeah, no, but I was yeah. Oh, it's
No, we had
yeah.
coffee.
Oh, that's right. We did have coffee. No, you're right. Oh yeah, yeah. No, yeah, we did have coffee.
Yeah.
Dude, after kids, like you don't remember anything. Everything's a
Yep.
blur.
Same boat.
No, but
Yep.
hey, Eli, for folks that are interested in learning more about what you're doing, what's the best way for we can leave in the show notes. What's the best way for people to reach out to you? LinkedIn?
LinkedIn, as we just talked about it, I'm using LinkedIn for the first time in my
I
career.
know. I was shocked to see that you had posted about the business in LinkedIn. So hey, look, guys, we'll link Eli's LinkedIn URL in the podcast. So if you are interested in QSRs, if you're a real estate investor, if this is something that you're curious about, follow Eli and send him a connection request. I'm sure he'll reach back out to you. Eli, thanks again for telling the story. Really, really, really enjoyed it.
I did as well. Great to catch up with you.
So, folks, if you enjoyed this episode and you want to hear, like these stories and want to hear more, please definitely leave a comment and subscribe. And again, please share it with family or a friend who's also interested in real estate investing. This has been a great episode. I think a lot of people would get a lot of value from it. So please do share. And thank you again for listening.